Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi everyone, this is Yazad. Thank you very much for being here today. I'm really excited about today's video because it is about a company that investors have been in a love and hate relationship over the last few years. India's very own meme stock, ITC Limited, which has suddenly come alive after a long hiatus, and everyone is talking about it and seems to have an opinion on it. Let's dig a little deeper and try and understand if this is all too much hype too soon, or is there a potentially massive opportunity going forward. Let's get right to it. Livingstone cichlid. Have you ever heard of it? The Livingstone cichlid, also known as sleeper fish, is a freshwater fish. But unlike other fish, there is something very unique about this species. It has a very unusual method of attracting its prey. It will lie down at the bottom of the ocean as if wounded. When its prey, typically smaller fish, approach, it will lie quite still. And even when its prey will take little bites of it, yet it will remain still. But once the prey is close enough, it will suddenly attack and eat its surprise prey. Looking at the stock price of ITC Limited, one cannot think of a better analogy. Sample this. On 24th February 2012, ITC was trading at Rs 209. Fast forward 10 years later, the stock closed at Rs 208.3 per share on 24th February 2022. For a decade, the stock languished at levels close to Rs 200, which made it Indian social media's favorite punching bag. Recently known more as a meme stock, with shareholders largely anguished by the lack of stock performance, the company has been at the center of furious debates and discussions among investors. Fund managers typically don't discuss individual stock picks, but when PPFAS Mutual Fund, a popular value-seeking fund, invested in the stock of ITC in 2020, a brouhaha erupted amongst investors, forcing Rajiv Thakkar, Chief Investment Officer of PPFAS, to discuss its position in the ITC stock and calm down irate investors. Such has been the sentiment for ITC over the last few years. And then all of a sudden, something changed. Since February 24th, the stock has surged by almost 30% in little less than 2 months. Today, the stock is close to its 52-week high, having outperformed a flat Nifty. Everybody on the street is suddenly very excited and bullish about the stock, with some analysts putting a target of Rs 450. But is this all too much hype too soon? Or is it like the saying goes, where there is smoke, there is fire? Let's dig in. For a moment, let us picture ITC as a big, powerful gun. A gun which was loaded in the 90s, patiently and carefully aimed and calibrated over the last 3 decades, and finally a shot has been fired. Loading a gun may seem like a basic concept, but many people do it wrong. When you load the ammunition incorrectly, it could cause a jam or misfire when you are in the middle of shooting. Why do good companies go bad? It's often assumed that the problem is paralysis. Confronted with a disruption in business conditions, companies freeze. But that explanation doesn't fit the facts. On the contrary, managers of besieged companies usually recognize the threat early and unleash a flurry of initiatives in response. For all the activity though, most companies still falter. The problem is not an inability to take action, but an inability to take appropriate action. In case of ITC, the management recognized the threat early that as smoking falls out of fashion, with heightened regulatory scrutiny and tax flows, it needed to diversify into other businesses. This resulted in the company diversifying into areas such as FMCG, hotels, paperboards and packaging, agribusiness amongst others. And this phase of ITC is akin to loading of a bullet into a gun. The paperboards and packaging division and the hospitality business have grown considerably over the years, but these revenues still contribute to less than 11% of the overall sales. What has been the highlight of this loading stage for ITC is the Agribusiness division's eChopal network. The Agribusiness division flagged off eChopal in 1990 as an IT-driven marketing channel to align farm output with market demand. And today it is the eChopal network that serves as the back-end source of raw materials that go into ITC's personal care products and packaging goods. eChopal enables ITC to source commodities at a much lower cost than competitors. This is because it buys directly from farmers, which eliminates intermediates and multiple handling, thereby reducing transaction costs. The network has also helped create a big rural sales and distribution channel for ITC. The company has used its eChopal to sell its FMCG products in rural India. And although it would be difficult to quantify the profit implication eChopal has had on the FMCG business, it seems to be pretty significant. Revenues for the Agribusiness have grown from Rs 968 crores in 2001 to Rs 12,883 crores in FY 2021, with profits also growing from just Rs 11 crores to Rs 918 crores over the same period. This has helped the top line of the FMCG business grow from a paltry Rs 22 crores in 2001 to Rs 14,757 crores for FY 2021. It seems the gun was loaded with the right bullet successfully. The one big caveat to taking a perfect aim is that it significantly slows movement. While aiming, one has to by default slow down their speed to identify and lock on a target. According to Newton's third law, every action has an equal and opposite reaction. In the case of a gun, that equal and opposite reaction is called recoil. In order to have accurate fire, one must account for the recoil pattern and manually adjust aim accordingly. Since the gun has been loaded, ITC has trained all its focus on one aim: to become the largest FMCG company in India. And just like aiming to get that perfect shot, ITC has had to recalibrate its strategy multiple times over the last few decades. Now, recognizing that ITC was perhaps not positioned to create long-term value in businesses such as edible oils and financial services, an exit from these businesses was executed. In the past, investors and analysts have often questioned ITC management's capital allocation strategy for its investments in the lower margin FMCG and capital-intensive hotel segments. In fact, 25 to 35% of capex every year was allocated to the hotel business, largely known for its lower return on capital employed. But recently, the company has moved to an asset-light model. The management has said that it will only complete existing projects and not start any greenfield projects in the cash-guzzling hotels and paper businesses. As a relatively late entrant to the FMCG industry, ITC made an aggressive entry by challenging incumbents on every single product vertical. Starting by competing with Hindustan Unilever and P&G with their own line of personal care products, the company even introduced its own line of biscuits, directly taking on Britannia and Parle-G. They also took on the noodles giant Nestle with their own brand of instant noodles. But although FMCG revenues now contribute to over 31% of ITC's revenues from just 0.22% of the turnover in 2001, margins have been dismally low at just 2 to 3%, even as some of its peers enjoy margins of between 15 to 20%. However, ITC has built its own products and brands from the bottom up without resorting to acquisitions in its initial years. And this brand building exercise takes time, huge capital outlay, and perseverance. But the company has had an unwavering focus to become the largest FMCG player in India by 2030. In 2001, over 80% of ITC's revenues were generated through tobacco. Today, only 38% of its sales come from the cigarettes business, 80% of its capital employed, and 90% of employees are in the non-tobacco businesses. This reflects the kind of investments and commitment the company has made over the last 2 decades, as it believes that there is still huge headroom to grow. ITC sees huge potential for market expansion with an estimated growth of between 4 to 5 times in key categories like snacks, biscuits, hand washes, branded atta, spices, body washes over the next 15 years. The company's integrated end-to-end distribution platform has been leveraged to widen and deepen the route to market through a robust multi-channel network that also caters to specialized segments, including climate control infrastructure for frozen foods, B2B channels for food services, as well as e-commerce. Over the years, the company has strengthened its core channels. In the last 5 years, market coverage has increased by 5 times and stockists have increased by over 6 times. ITC has also branched out from just grains to processed foods and most recently into fresh farm produce. Its knowledge of the Indian market gives it an edge over foreign brands. ITC's high-quality brands today have garnered consumer spends of over Rs 22,000 crores and are present in more than 150 million households. Several of the company's FMCG brands have achieved leadership positions. Interestingly, the return on capital employed, or ROCE, and the earnings before interest and tax, the EBIT, for the FMCG segment, which were negative until 2014, have gradually increased, but since 2018 have more than doubled. Margins are up by 640 basis points, that is 6.4%, between FY17 and FY21. It looks like the long painful wait for the perfect aim may have been worth it. And the shot has finally been fired. Now all that's left is for the company to follow through. As with many other facets of life, there is one more hurdle to mastery, and that's follow through. Follow through is the final step in the integrated act of firing the shot. Follow through is the glue that holds the other fundamentals together and makes firing the perfect shot possible. From recent financial reports and the company's investor communications, it seems that ITC's investment phase in FMCG and hotels is nearing completion, and payback has already begun. While investments would continue in FMCG as the company is open to acquisitions, the segment is now capable of funding them on its own. A few years back, this situation did not exist. For the 9 months period ended December 31, 2022, the FMCG segment has generated a profit of Rs 696 crores. The hospitality business, which was severely hit by the pandemic, has also turned a corner in the December quarter with a profit of Rs 53 crores as against a loss of Rs 156 crores in the corresponding quarter. Some FMCG brands are already generating surpluses, and as these established brands progress, they will generate value which will be deployed to create newer brands with some part retained as surplus. ITC is also confident of growing with year-on-year margin improvement of about 1%. Looking at the synergies that ITC has in the agribusiness, hotels and cuisine, besides distribution, it makes perfect sense that food is the best fit for the company. Having built the base over the years, now there is more focus on value addition. India's potential in agriculture is immense. Experts have assessed that India's agri-exports, which currently account for only 2.5% of global share, can be doubled over time. The recent policy measures announced by the government, once implemented, bode very well for the agri industry and particularly for ITC. The company's agribusiness has grown on the back of double-digit growth over the last few years and is expected to post a profit in excess of Rs 1,000 crores for the first time in FY 2022. Recently, the Russia-Ukraine conflict has sent wheat prices soaring, potentially benefiting ITC's agri division that exports wheat as it is looking to gain markets that traditionally imported wheat from Russia and Ukraine. ITC could also potentially benefit in other grain exports such as rice in case consumers globally start consuming more rice due to higher wheat prices. Agri exports constitute 56% of ITC's aggregate forex earnings of $7.3 billion over the last 10 years. FMCG brand building takes time. Dabur India Limited was established in 1884, Hindustan Unilever in 1931, and Marico Limited in 1994. ITC, being the latest entrant, has achieved leadership in several operating segments within a relatively short span of time as compared to any of these players. Ashirwad is the market leader in Atta. Classmate is the leader in notebooks segment. Bingo is number 1 in the bridges segment, whilst Yippee is a strong number 2 in instant noodles. When ITC launched its instant noodles Yippee in 2010, Nestlé's Maggi had a near monopoly with a market of over 90%. In just over a decade, Yippee has close to 25% of the market share. The company has been relentlessly pursuing leadership and higher market share with sustained investment and continuous innovation. Savlon, which was acquired from Johnson & Johnson in 2015, has progressively grown over 13 times and become another rupees 1,000 plus crore brand in a little over 5 years. Another acquisition, a neem-based natural floor cleaner, Nimil, has grown by nearly 4x. More recently, ITC acquired spices manufacturer Sunrise Foods Private Limited in its biggest acquisition till date. It is estimated that the branded spices market is set to double in size by 2025 to rupees 50,000 crores. And Sunrise is a market leader in Eastern India, and this acquisition will enable ITC to address the growing opportunities in branded spices in underpenetrated markets. Coming to valuations, if you look at valuations for FMCG companies, HUL has a PE that is price to earnings ratio of 59. Marico trades at a PE of 60 and Dabur is at 68. On the other hand, even with the recent rise in price, ITC has a PE of just 22. It is evident that the company is still not regarded as an FMCG major by investors. But the numbers show that the company's FMCG business continues to scale rapidly, and ITC is now the second largest FMCG player in India by revenue. Through all the trolling and negative news over the last few years, ITC has demonstrated resilience. And let us not forget that the cigarette vertical of ITC is a cash cow unmatched in its yield in corporate India. While it may see a decline going forward, it is still a thriving business. A lot of its investments in its new businesses are getting concluded as the foundation has now been laid. Hence, incremental investments in the future will not be as much. And recently, there is a gradual change in perception as considerable growth in non-tobacco revenues and profits indicate that the company was ultimately right in its strategy to diversify into these new businesses. The shot has been fired, and ITC has finally exited a painful decade. Over the last decade, ITC's diversification efforts have failed to boost its stock price as investors have been concerned about high cigarette taxes, ESG headwinds, diverging global trends, and an underperforming FMCG business. But it seems the worst is behind for the company. In a research note published recently, Morgan Stanley said it expects FMCG profit contribution to gradually increase to 8.5% and 12% over the next 5 and 10 years, from 3% currently, with margins estimated to improve to 11% and 17.6% by FY25 and FY35. It also expects the FMCG business to contribute to dividends over the next 5 years. Another concern has been the uncertainty over high cigarette taxes, as taxes were increased by over 150% between 2010 and 2019. The budget 2022 has not changed taxation on cigarettes for the second consecutive year, indicating stable pricing, which indicates going forward, tax increases will be more reasonable. Now, since 2018, institutional investors have placed a high value on ESG factors. This has hurt the global tobacco sector in general. But ESG is something that is evolving. Investors are now beginning to understand that ESG is not simply about exclusion, but rather it is about the manner in which companies are conducting business. ITC carries a very unique global distinction of being carbon positive for 16 years, water positive for 19 years, and has been following solid waste recycling policy for 14 years now in a row. About 41% of its total energy consumption comes from renewable energy, and the company aims to completely meet its electrical energy needs from renewable sources by 2013. ITC's eChopal services today have empowered over 4 million farmers. Its Women Economic Empowerment Program has created over 80,000 sustainable livelihoods for women, and its primary education program has benefited over 775,000 children. Turnover from the tobacco business now accounts for only 38% of its total revenues. As per a global ESG rating company, Sustainalytics, ITC is ranked number 1 globally among global tobacco companies and number 3 overall on ESG performance in the foods products industry. The company has been recently included in the Dow Jones Sustainability Emerging Market Index, So it seems that ITC actually ranks amongst the top companies in terms of its ESG efforts. The ITC stock has not done much over the last decade. However, when you look at various stocks, you see that in their journey, they've had these extended periods of time where either they've corrected due to excessive valuation in the past or have just stagnated at the same levels due to a low growth scenario. In fact, if one was to look at the FMCG major Hindustan Unilever, it went through such a patch from 2002 to 2007, even though it coincided with one of the strongest bull runs in the Indian equity markets. HUL was a big underperformer in that cycle. Between 2002 and 2007, the Nifty went up by over 250%, whereas in the same period, HUL was actually down by 19%. But for the next 5-year period, between 2007 and 2012, HUL was actually up by 97% as against Nifty being down by 6.5%. Value-seeking investors know that it makes sense to pick up a fundamentally strong stock which has underperformed over 3 to 5 years rather than just buying a stock at a 52-week low. Analysts and experts know how to forecast the future, but it's 100-year-old companies like ITC which know what action they must take in the present to make their own future. Now, history will tell us that ITC put all its weight behind its FMCG business. Was it enough or not? Only time will tell. That's all we have for this week. Thank you very much. Hope you enjoyed seeing this video. Goodbye.